Welcome to the economic side. In this video we are going to discuss about Netflix. Netflix Incorporated's earnings report couldn't fully satisfy investors, but it was good enough to prompt a bevy of bullish analyst calls, with even the most bearish on Wall Street boosting his price target. The streaming video giant reported late Thursday earnings and all-important net subscriber additions that handily beat expectations, while revenue came up a bit shy. With the stock in FLX, minus 3.99% soaring 51% in the weeks leading up to the results, investors' expectations were running high at no wonder shares slumped 3.6% in afternoon trade Friday. But an overwhelming majority of Wall Street analysts got a little more bullish. Of the analysts surveyed by FactSet, no less than 17 raised their price target, while only 2 lowered them. That raised the average target to $403.56, which is about 19% above current levels, from an average of $391.31 just before the release of results. The average rating remained at the equivalent of buy. Analyst Mark Mahaney at RBC Capital Markets boosted his price target to a street-high $480 from $450, citing strong fourth-quarter results and expectations that revenue growth and margin expansion will accelerate, as the latest subscription price hike is likely to be successful. Netflix offers a truly compelling value proposition with global appeal, Mahaney wrote in a note to clients. We believe that Netflix has achieved a level of sustainable scale, growth and profitability that isn't currently reflected in its stock price. Raymond James' Justin Patterson reiterated the strong buy rating he has had on the shares for at least the past 3 years, and lifted his target to $470 from $450, saying Netflix's global distribution advantage is becoming increasingly clear. He said the results confirmed many elements of his very bullish view, including the ramping of the international business, that Netflix's global distribution is a material advantage, share gains in media and entertainment are increasing, and the clear long-term profit vectors, such as pricing and margins. With revenue growth poised to accelerate, margin expansion in the second half of 2019, and free cash flow burn moderating in 2020 and beyond, we struggle to see the bear thesis, Patterson wrote. Even with Friday's pullback, the stock was still up 55% over the past 12 months, compared with a 2.0% decline in the Nasdaq Composite Index Comp, plus 1.03%, and the S&P 500 Index SPX, plus 1.32%, 4.7% fall. Wedbush analyst Michael Pachter reiterated the underperform rating he has had on the stock since at least July 2016, as he tried to explain his most bearish view. We expect content spending to trigger substantial cash burn for many years, notwithstanding 4 Netflix price increases in the last 5 years, cash burn continues to grow, Pachter wrote. International profits may remain elusive due to competition for content and subscribers, and future content migration and price hikes could cause a deceleration in subscriber growth. Still, Pachter raised his price target by 10% to $165, that was 52% below current levels from $150, due primarily to a less bearish view on Netflix's international business. His per-share valuation of international increased to $62 from $45, while his valuation of domestic slipped to $102 from $104, and his domestic DVD valuation stayed at $1. Elsewhere, analyst Doug Anmuth at J.P. Morgan got a little more bullish on Netflix, reiterating his overweight rating while raising his price target to $435 from $425, despite some concern that the latest price hike could lead to fewer subscriber additions in 2019 than last year. He said the price increase could have less impact than expected, and recommended buying any weakness in the shares. The underlying global secular shift toward on-demand entertainment remains strong, as does Netflix's original content slate, Anmuth wrote. Piper Jaffray's Michael Olson affirmed his overweight rating and boosted his price target to $440 from $430, but acknowledged that Netflix's fourth quarter results and first quarter outlook were mixed, as domestic subscriber ads fell short of his expectations. The single most important metric to investors, however, is international subscriber additions, and that was ahead of expectations for the quarter, and the guide, Olsen wrote. And with just 15% share of internet households outside of the US, excluding China, there's clearly room to grow international. Thank you for watching this video, really appreciate your help.